Hey everyone, Mo is here from Wall Street from Main Street, and today as a returning guest, we have Brent Johnson. He is a former Wall Street analyst and the founder of Santiago Capital. Brent, thank you for coming back. How you doing?
Absolutely. It's good to be here. I appreciate you guys inviting me on, and we're kind of rounding out the year here on some interesting times, so it's good to talk to you.
Yeah, and a happy holiday to you. We're getting close to the end of the year. This year went by pretty fast.
Yeah, absolutely. It always goes fast. Now, I've got an 8-year-old son, and I think it goes quicker when you have kids, and it's just hard to believe how fast they grow up.
Right. I can't relate to that yet, but one day I will.
Someday. Yeah.
Yeah, yeah. So I want to today's podcast. I want to talk about 2016 since we're getting close to the end of the year.
Yeah.
I thought we do a review of 2016 and talk about major events that happened in the market and the economy in 2016, and also looking forward to 2017 and what we should expect to happen. So I want to start off by talking broadly, and let's talk about the stock market. We had a lot of volatility in the stock market. If you look at the chart for the stock market, we had a downturn in January and then it formed a double bottom, and then it went its way up, and then it went sideways right before the election, and then, as you heard in the news, all-time high for Dow Jones, it hit 19,000, and also for the S&P 500, I believe, as well.
Right.
So let's talk about the volatility in the stock market and the cause behind it, and what do you think it means for investors on Main Street?
Sure. Well, so for the investor on Main Street, it probably means a lot of confusion and wondering what the heck's going on, especially for people who look at it closely. In general, I think people on Main Street should figure out a good advisor to work with. And when I say a good advisor, not necessarily someone who just repeats everything that Wall Street says, and get on some kind of a savings plan where you put a certain amount of money every a month away into some kind of a very diversified, conservative, for lack of a better word, portfolio, not just blindly throw everything into the stock market, and really not get too caught up in the day-to-day moves or in the week-to-week moves. But that said, I also think we're at a very kind of a critical time in history, and I think the next couple of years are going to be much more volatile than the last few have been. We've been on this, 6 or 7 years where everything's just kind of trended up or sideways, and there's been little pockets of volatility, but in general, volatility has been pretty low. There were some periods this year where it wasn't. We can talk about that in a little bit more case, but long story short, this year has been interesting in that at the very beginning of the year, it started off with kind of hyper volatility, and I think, going back to what I just said, you look back at 2014, 15, there wasn't a whole lot of volatility. Again, there were little pockets of it, but in general, volatility was low. And I think whenever volatility is held low for a long time, it just sets up for these spikes of volatility, and that's one that we saw earlier this year. And I think what initially drove that earlier this year was a couple things, and it's a couple things I've been kind of focused on for the last, 12 to 18 months, and that is a result of the strong U.S. dollar as well as the potential devaluation of the Chinese yuan. And, you saw, at the beginning of the year, the Chinese yuan was weakening, and it was weakening rather quickly, and that led to a lot of volatility around the globe. And I don't remember the exact number off the top of my head, but I think the S&P started off around 2,100 around the year, and by the middle of February it was down to 1,830 or 40 or something like that. So it was down 10 or 12% in the first 6 weeks of the year. And it was kind of interesting. I don't remember the company, but there was one firm, it might have been Bank of Scotland or something, where it came out and they had a report second week of February. It said, sell everything. And unfortunately, that turned out to be the absolute bottom. And since then, the market, rallied back to flat within 3 or 4 weeks from there. And I think by the end of the first quarter, the market was flat. And it stayed relatively flat, through the summer. Even into the third quarter, I think it was up a little bit. And there was not a lot of volatility, from March until September. There was a little bit of volatility in June, but it was over within a week, I think. There was another little bit of volatility in September, but it was over pretty quickly. So in general, we had pretty low volatility for the year, and then we got into, the election, and that caused, about 24 hours of volatility. But since then, the market's been on a tear, and, the market's been on a tear mainly from Trump getting in. And I think the most interesting thing about that is, again, all the experts were wrong. All the experts said Trump will get in, it'll lead to a global crisis, stock markets around the world will tank, et cetera, et cetera. And I think because everybody told them that and all the experts predicted that, when people realized that Trump was going to win on the night of the election, that's what markets started doing, because that's what everybody told them they should do. But then once people started thinking about what Trump's policies actually were and what he had actually said he was going to do and how that would actually affect the markets, they came to the conclusion that this will actually be good for the equity market. And since then, we've had this reflation trade where, interest rates are rising rapidly, growth expectations are rising rapidly, bonds are selling off on this reflationary trade idea, commodities, with the exception of gold, and we can talk about that a little bit as well, have been trending up. So, in my opinion, it's way overdone. It doesn't mean that we're not going to have a little bit better growth, over the next 6 months than we've had over the last year or so. But, I don't think that we're going to get back to this breakaway growth where all of a sudden, we're compounding GDP at 3 or 4%, and that rates are normalizing. I just don't think that's possible. For a lot of reasons that we can get into. But so, the year, I think the market is now up 8 or 9%, maybe 10% on the stock market. Gold is up around the same amount. So I think, for a long time, gold had a really good year in the first 2 quarters. Third quarter was kind of flat. Now the fourth quarter has been pretty tough for gold and probably halved its gains. And so now I think at this point, the stock market and gold are kind of up equal amounts for the year. That was kind of a long, rambling answer to your question, but happy to dig into any of that in more detail if you want.
Oh, no, it's okay. Yeah, gold is up 12% from last year, and silver is up 18% from last year. And then also we just saw U.S. dollar make a 13-year high.
That's right.
Then also this year we had the Fed raise the interest rate, although it's very little. If you look at the overall chart, it's a blimp on the chart compared to what they did back in the 70s with Volcker.
Right.
But this is a different time period because we have a lot of debt. We're over leveraged.
Exactly.
We didn't have that problem in 1970s. I don't think Volcker would have done what he did today in this current environment. So not fair to compare that situation to this. I think the Fed are kind of handcuffed on what they can do right now because they raise the rate. They know the consequences of what would happen.
Well, I tend to agree with you. And what I tell people a lot of times when we start getting into rates conversations is I say, listen, rates can go up a little bit more from here because they were so low that they can go up a little bit without causing too much damage. They can stay low for a very long time, and they could spike in some kind of a collapse or in some kind of a breakaway growth, but they can't normalize. Going back to 3 to 4%, 4.5% on the 10-year. It just doesn't work. The debts are way too big. The debt service would be way too big. And, to get back into a normalized environment would, the debt service on the debts around the world itself would throw us back into a major recession. So I just don't see rates normalizing anytime soon. And I think when rates really start to rise, it won't be because of growth, but it'll be because investors are repudiating the debt and they want to get paid more for the credit risk they're taking, not because we've gotten into this growth period.
Yeah, and connect the Federal Reserve to Trump's economic plan, which is being called a quote-unquote pro-growth agenda, where he tends to grow the economy through infrastructure spending, cutting taxes, cutting regulation, which is all great, but when you consider the interest rate this low, once we start seeing inflation, the Federal Reserve may want to start raising interest rate, just like they did in the middle of the housing bubble a decade ago in 2005 onward, where they start raising rate because of the high inflation. We could see something like that happen and that
Yeah.
could leave the Federal Reserve no choice but to raise the interest rate.
Well, yeah, I mean, and that's true. But again, I think if they do, if they raise rates too much, then it throws us back into a recession. Now, I should state that they should raise rates. Actually, they should just get out of the way and do nothing and let the market set the rate. So, it's not that I think that they should raise next month or 6 months from now. I think they should have raised 6 or 7 years ago and just got back to normalization. I don't think the only way for us to normalize is for a lot of these debts that are on the books to be wiped out. Otherwise we're just going to get into this stagnant period like Japan for two decades. And, I think the debts are so big that we can't roll the debt for 2 more decades. And so I think the crisis will become, much sooner than that, as these debts either get paid either through inflation or through a deflationary bust. Right.
So another economic current event that happened this year is the collapse of the Euro Bank, or the upcoming collapse of the Euro Bank. We saw a lot of news and talked about the banks in Europe are pretty much insolvent, just like the banks here in the United States. They're insolvent too. A lot of concern about the biggest bank in Germany, Deutsche Bank.
Yeah.
I think I'm saying it right. I call it Deutsche Bank, but it's Deutsche Bank.
Yeah.
Anyway,
well, a lot of the European banks are in trouble. You're hearing a lot about Italy now because they have a referendum coming now. But Spanish banks are having trouble. Swiss bank, both UBS and Credit Suisse are having troubles. So it's not even just one individual bank anymore. A lot of them did not recapitalize after the global financial crisis to the same extent that the United States did. So they are having to go to even more extraordinary measures perhaps than we did sub the crisis, and here we are 7 or 8 years later, and they're still doing it, and they've even gone to negative rates, and in my opinion negative rates are not inflationary, they're deflationary. And so these negative rates that they have over there are even punishing the banks even more than they were before, and it's just leading to a vicious cycle lower, in my opinion. And Draghi and the Carney of Bank of England and some of the others over there, they're actually benefiting to a certain extent from the strong dollar. The dollar's getting stronger, the euro's getting weaker, and that's actually providing them a little bit of cover. It would be even worse if their currencies were appreciating.
Right. I think I asked you this on Twitter one day, but when you said that negative interest rate is deflationary, how so? Because when the negative interest rate, they're forcing people to spend the money they have in their bank account rather than letting it sit there.
And so that's the way it works in the ivory tower model, but in the real world, I don't think it works that way. And let me explain what I mean. So if negative rates are, let's just say they're 1%, they're not even 1%, but let's pretend that they're 1%, right? And so now you've got a medium cap or small cap German manufacturer who have to make a decision. Let's say they've got $2 million in the bank, and they've got to make a decision. Do they leave that $2 million in the bank, or do they go out and spend $1 million on some new warehouse or some new plant or some new manufacturing facility, right? So they've got to go out in this economy that's very weak, where they're having trouble, there's anemic growth, and they're going to go spend $1 million building a new plant, or pay a $4,000 tax, or pay a $10,000 tax on that $1 million. Right. And so I don't know of any, European CEO who's going to go spend $1 million in order to save 10,000 that they have to pay in negative interest rates. Now, if that negative interest rates get to negative 3%, 5%, 6%, then that's a different story. But right now, the rates are like a negative 40 basis points or a negative 50 basis points. And at that point, I think they say, you know what, this really sucks. I hate it, but I'm just going to pay that tax, or I'm going to pay that negative interest rate, and I'm going to keep my powder dry for another day. So in theory, negative interest rates are inflationary, and I think if they get negative enough, they would in fact be inflationary. But at this level, I don't think that they're inflationary. And I would, if somebody can prove me wrong on this, I would love to hear it. I'd love to hear, from some CEOs or some executives in Europe who are out there trying to spend money because they're afraid of paying a 40 basis point negative interest rate.
Yeah, and right now we have negative interest rate in Japan, and it seems to be not working out
exactly
for their economy. So
right.
the central banks are pretty much out of options to try to stimulate the economy. I mean, they could always print more money, but the law of diminishing return kicks in here. And if you look at the chart for the stock market, I mean, the all that money they printed, the return is starting to go down year after year.
Well, we've just got no money velocity. They've printed all this money, but it's not getting into the economy. It's sitting on the bank balance sheets, and there's no multiplier effect. And until we get some money velocity to go along with the printing of currency, we're in deflation. We've seen an uptick in inflation expectations over the last couple months, but we've seen this several times over the last 6 or 7 years, and it's never held. So I need to see a little bit more evidence that it's going to hold this time before I jump on the inflationary train.
All right. So another economic event that happened this year is the Brexit, which happened in July, and we saw a lot of volatility in the stock market. Saw a big drop on the S&P. It went from 2,100 to almost below 2,000. So we saw a big drop there, and a lot of concern that it would be bad for the economy in London since now they're going to be out of the EU.
Right.
So let's talk about that and the impact that it will have on the stock market and for the global economy.
Well, it's kind of funny. For years, all these central bankers have been trying to kill their currencies in order to stimulate inflation. Carney got exactly. He must have been all the other central bankers in the world must have been so jealous of him the night of Brexit because the pound went from like 140 to 120 or whatever it was. I don't even remember what the exact number was, but it was I think it was the biggest move in the pound in 20 or 30 years or something like that. Long term, I think it's actually great for the UK to be out of the euro system. You've got individuals kind of self-determination again, rather than some big bureaucracy in Brussels who has no idea what's going on in Western United Kingdom, making decisions for them. So. Long term, I think it's a very good thing, but short term, I think there's going to be some growing pains as they kind of and some volatility as they figure out what the heck they're going to do because even though the popular vote was to leave the euro, they haven't actually signed the paperwork to do it yet. And I think the new prime minister has said she's going to start the process in March, but that's still 3 or 4 months away. And I've seen reports that even if they started in March, they wouldn't be able to, finalize it for 12 to 18 months after that. And so, not only that, they've got to, if they're not part of the euro anymore, now they've got to negotiate new treaties with all the European countries, right? So, what they're going to actually do and how it's going to play out, there's a lot of uncertainty, and markets hate uncertainty. And so I think in the short term, that's going to cause some pain for the United Kingdom, but long term, I think it'll be very good. But you just don't know what's going to happen. I mean, you saw former Prime Minister, I forget his name now off the top of my head, but Tony Blair on Friday was saying that we don't have to accept the Brexit vote. There's a way to stay in the euro. So the people in Brussels and the people in power in the UK to a certain extent they're probably going to try everything they can to derail the whole Brexit thing, but I just don't see how they can do it without having massive uprising from the citizens.
Right. And Italy's in the same situation right now. They're going to vote soon.
Exactly.
Rather to leave the EU. So I think they're going to do it too.
Yep. And and all this uncertainty with the euro, in my opinion, is going to lead to a weaker euro, and that leads to a stronger dollar. And I've been on this thesis for a while that the stronger dollar is absolutely going to happen. And it's going to happen not because the dollar is a great currency, but just there's some structural issues in the world economy, and the dollar is going to get stronger. That's going to lead to a lot of pain around the world. And I think it is going to be the reaction to that strong dollar that is eventually going to lead to some inflation or, a real move in gold, and where people just kind of say, you know what, the monetary establishment, the monetary authorities, the political leaders, they're just out of touch. They don't know what they're doing, and the central bankers are out of control and don't know what they're doing. And I think that's when you're really going to start to see some big moves in asset classes. I should take a step back and say, the dollar is an extremely flawed currency. All you have to do is look at the value of the dollar over the last 100 years, and you realize it's lost like 95% of its value. This has to end in high levels of inflation because if it doesn't, then it's going to end in a depression. There's really no two ways out of it. You either get high levels of inflation or you get a depression. And so, the monetary authorities are going to do everything they can to stoke this inflation. But I don't think, at least in the U.S., I don't think that the Fed has the political capital to go out and do another huge QE program at this point without there being a significant amount of pain first. They've been talking about, they raised rates last December. Their expectations were to raise 4 more times this year. They haven't done it. Now we're getting, the expectation is that they're going to do it again in a few weeks. And maybe they will, maybe they won't. I don't know. And to be honest, I don't really care because I don't think it matters that much. But it's 100% priced in that they're going to raise now. So for them to flip around and say, not only are we not going to raise, but we're actually going to institute another monetary stimulus program by doing a $5 trillion QE program or whatever the number is, that would blow their credibility out of the water. And all currencies, all fiat currencies are a function of trust and confidence. And as soon as the trust and confidence is gone, the currencies are gone. And if the currencies go, then the bonds go, and that's when we get that's when you get either a deflationary collapse or a hyperinflationary collapse, or whichever way it goes. But I just don't think we're there yet. This has gone on longer than I thought it would. But now that we're in it, I don't feel like we're at that moment where it all ends tomorrow. Now, I could be wrong. You have to be prepared for it to end tomorrow. And I think anybody who goes through the next couple of years without owning gold, because of this scenario that I'm laying out, is an absolute fool. Without being, I guess with all due respect, I think you absolutely have to own gold in this environment as an insurance policy against the status quo and against the monetary and fiscal authorities' hubris. But I just don't think we're at that end game yet. I think we've probably got a couple more years to go before that happens. And I think all of that's going to come as a result of the stronger dollar. And I put out a presentation over the summer, which I called Step Into Liquid. And it was kind of a play on, there was a surfing documentary about 10 or 15 years ago that called Step Into Liquid. And it was about these waves all over the world. And, I see all these waves in these different asset classes around the world that are kind of crashing now, and they're all kind of leading to a stronger dollar. And so I think that stronger dollar leads to lack of liquidity in markets, and I think liquidity is everything. When liquidity disappears, asset prices disappear as well. And so I think we're getting into this stage where a result of there were 6 different things I talked about in this presentation. I'd be happy to send it to you if you didn't see it. You can post it on your website or send it out to your listeners, or they can contact me directly, and I'm happy to send it to them as well. But the 6 different waves that I talk about are the debt supercycle and how big the debts are, and a lot of those debts are issued in dollars. And if you think about a bond is basically a future demand for a dollar. When that bond matures, you want to get paid back in the debt in the instrument that you issued it in. So all that debt out there that's in dollars, that's future demand for dollars. I also talk about the stock and flow dynamics, of the monetary system. A lot of people don't even understand how the monetary system works and how money gets loaned into existence. So the money supply itself has an interest payment associated with it. And if the monetary flow or if the velocity of money is not high enough, the interest doesn't get paid, and you get into a collapsing monetary system environment. So that's one of the waves that I think is crashing. The petrodollar is another wave that I think is crashing. You've seen in the last couple months a big drop. There's this thing called the TIC data. I think it's the Treasuries and International Custody. I think that's what it stands for. Basically, foreign ownership of U.S. Treasury bonds has been plummeting. And part of the reason and that's kind of contributed to the rise in yields. And I think the reason that that's happening is countries like China and Saudi Arabia and other big holders have these dollar-based, obligations that they have to pay, and that they're not getting the dollars from their traditional economic operations. And so they're having to sell their dollar-based assets in order to get the dollars they need to fund their operations. So I think that The petrodollar is a big wave that's affecting liquidity. Also, the regulatory environment. There's been some change in money market funds that came into effect in October. That has led to a big change in the money market world, which has led to increased costs of funding for banks and other corporations, and that has led to rates going up as well. And so that puts more pressure, funding pressure on markets. Another wave that we talked about was China. I still think that the slowdown in the global economy is leading to enormous pressure on the Chinese authorities to devalue their currency. If they let their currency go now and just floated it without having intervention at all, I think the currency would devalue by 20% at a minimum and probably closer to 30%. But all these different waves are leading into a lack of liquidity in the markets, and I think it's leading to a stronger dollar. And as you mentioned earlier when we were talking, the dollar hit a 13-year high. There haven't been that many dollar bull markets in history. There was one back in the 80s, another one in the 90s, but it's been 15 or 20 years since we've had a dollar bull market. But they typically go pretty high when they do, and I think we've broken through long-term resistance if you look at a chart of the dollar. And it's come a long way just in the last 2 or 3 weeks. It wouldn't surprise me if we have a little bit of a pause here, but I think going into 2017, I think the dollar continues to get stronger. And if rates rise, that actually makes the dollar even stronger, because if our rates are going up and around the world they're holding them lower and doing QE operations and extraordinary monetary programs in order to weaken their currencies, that makes an even bigger demand for dollars. But I think that strong dollar will lead to this growth that everybody's believing in now. I think that will be tempered. I think the strong dollar will lead to a slowdown in emerging markets, which will lead to a slowdown in global growth. And I think a lot of these gains that we've seen in the last 2 or 3 weeks on the equity market because of all this newfound optimism for growth is going to be severely tested in the first half of 2017.
So one last thing to cover for 2016 is gold and silver. So gold and silver was up 30% at one point in the summertime right after the Brexit vote. I saw a big pop up there. Right. A lot of the mining stocks were up, some of them were up 1,000%. And a lot of the mining CEOs finally saw some sunlight and started to see some positive cash flow. And then in the fall, we saw the correction. Now, it was expected to happen, because nothing goes up every day forever. Right. So we saw a correction, and then we saw a little pop up after the election, and now we're back down again. Got slammed hard last week. But overall, still a pretty good year for gold and silver in a double digit in return wise. So let's talk about why gold and silver went up this year, and what do you think would happen in 2017 for the metals?
Okay, so anybody who's ever heard me talk before, and as I mentioned earlier in this talk, knows that I'm a huge believer in gold. You absolutely have to have gold in your portfolio going through an environment like we're going through now. I think it should be the anchor of every portfolio, and I also should say that I think with Trump now getting in as president, the policies that he's going to run, or not that the policies that he ran on and that he's going to try to implement, I'm more convinced than ever that gold is going to go much, much higher. For a long time I've said gold's a lock for $5,000. I don't see any reason to take that off the table. I think in the years ahead that will absolutely happen. That said, I think over the next couple of months, gold has some challenges. So if we talk about the first 6 months of the year, it was really kind of a perfect storm in a positive way for gold. So if we go back to the very beginning of the year, if you look at the commitment of traders, which is a way to look at how people are positioned in the futures market, we can get into whether, the futures market, paper market sets the price, or whether the physical market sets the price. I'm a believer that you should own physical gold. But majority of the trading that goes on in the gold world is done in the paper market. And if you look at the way they were positioned at the beginning of the year, it was an extremely bullish setup in that the commercials, which are the big banks and the people who actually produce the gold, were almost net long for, I think, the first time ever. And they didn't have a big short position. But all the speculators had a huge short position because going into the end of last year, gold got whacked down to, the 1050 level. And so that positioning was extremely bullish. So you have that coming out of the beginning of the year. So that was one bullish thing for gold. The second bullish thing was that at the end of January, I think it was like January 20th, was the Davos Economic Summit in Switzerland. And one of the big topics coming out of Davos was negative rates and banning of cash. So that was a popular theme that was discussed at Davos. And literally the Monday or the Tuesday after that weekend meeting, gold started to really jump. Actually, the miners, I remember coming in late January, it was like the third week of January, I came in and bullion was flat and the miners were down 10% one morning. I came in and for no reason the miners were down 10%. And then we went into the weekend for that, and it was that Davos Economic Summit. And then after that, they started talking about negative rates, banning of cash, et cetera, and gold kind of took off, and the miners took off. And by the middle of February, here's the interesting thing right now. By February 12th, we were higher than we are today. But by February 12th, I think we were up to like 1250 on gold at one point. Now it fell back to around 1220, but it stayed in the 1200 range for the next 3 or 4 months. And then the Fed, who was supposed to raise rates, didn't raise rates, and so that was bullish for gold. Then we get into June, we have Brexit. That was a big positive catalyst for gold overnight. It jumped up to like 1370. Then it came back down overnight, but then over the next month or so, it kind of bounced around between, I don't know, call it 1280 and 1360 or something like that. Yeah. But we had all these things that happened in the first half of the year that were extremely, extremely bullish for gold. But here's the interesting thing is, Brexit. I remember a couple of years ago, Cyprus, kind of went under. Greece had their crisis. All those things were supposed to be positive for gold, and they really weren't. Brexit was supposed to be positive for gold. It just didn't happen. Now we had Trump was supposed to be positive for gold. It bounced overnight, but then it didn't happen. And what I think has happened over the last 3 or 4 months is a couple things. One is that commitment of traders statistic that I talked to you about completely reversed itself. By August and September, we were at all-time highs for speculators being net long. We were at all-time highs for the commercials and the big banks and the producers to be net short. Now, that has worked itself off a lot over the last 2 months. It's decreased by about half, but it's still kind of bearishly set up. So that was one thing. The other thing is that the big catalyst, the Brexit catalyst, the Trump catalyst, those are behind us now. We don't have one of those big catalysts up ahead of us. Now, the next catalyst I see is this Italy referendum that's happening this weekend. But in many ways, that would be negative euro, I think, and positive for the dollar. Now I actually believe that in the years ahead, the dollar and gold will rise together, which is kind of unheard of, but I do think it will happen. And that's kind of the reasoning why it's kind of laid out in that step into liquid presentation I talked about earlier. But in the very short term, a strong dollar is a headwind for gold. It doesn't mean they can't both go up. It just means it's a headwind for it. So, now we've got that. We've also got this period. I think we've got this grace period between Trump getting elected, Trump getting inaugurated, and his first 100 days in office. Everybody seems to now be giving him the benefit of the doubt. They think that his policies are going to be inflationary, and they're pro-growth, and we're going to have lower taxes, and that's going to lead to corporate profits. And so when that started happening, a lot of these inflationary assets started picking up, but gold started to get sold off. And I saw a lot of people in the gold world saying this doesn't make any sense. Inflation is picking up. Gold's an inflationary asset. Gold should be doing well. And my thought on this is that that's absolutely right in the long term, but I think that in the short term, when inflation starts to pick up, the initial the initial spurts of inflation, I think, are negative for gold. And the reason I think that is because gold is really hard for people to get their head around. For whatever reason, it's just very hard to talk to the common guy on the street and have them understand gold. And it's also very hard for somebody who works on Wall Street to understand gold because they've never been taught about it. They don't understand it. They think that their models are correct, and they think that this economy that we've built can just keep rolling on and roll the debt forever. So when you start to get these initial indications of inflation, I think they think it's not bad inflation, it's good inflation, it's growth inflation. So let's go buy real estate because real estate prices are going to go up. Let's go buy stocks because stock prices are going to go up. Let's go buy copper because they're going to need to make more widgets and refrigerators and boats and cars and steel and copper and all. So I think that initial euphoria of the inflation is seen as good growth. And I think it's not till inflation starts to rear its head in a bad way that people start to then go to gold. And so I think we're in this grace period where this pickup in rates, this pickup in growth, this pickup in, I don't know, maybe you just call it animal spirits or mood or sentiment or whatever it is. I think that in the short term is negative for gold. But all of that stuff leads to the most positive outcome for gold imaginable in the medium to long term. So that's kind of my thought on gold over the last couple months. We had come a long way really fast. I think we needed to have a little bit, take a little bit of a breather. The commitment of traders had to get worked off a little bit. That's a long way done now, but I still think there might be a little bit more to go. And now I think we're still in this grace period where this uptick in rates due to the growth policies of Trump are creating a little bit of a headwind, as well as the strong dollar. So long term, I've never been more positive for gold. You absolutely have to own it. You're absolutely crazy if you don't own it. But it doesn't mean that it's going to happen in a straight line, and it doesn't mean it's going to happen overnight. So that's kind of my thoughts on gold.
Do you find value in the commitment of traders report? Because I don't. I used to follow that thing on a weekly basis, go ahead.
I don't put 100% confidence in it. I wouldn't trade 100% off of what it says. But I've typically found when everybody's thinking one way, somebody's wrong. And when you've got at one point in July, late June and July, if you looked at the bullish percent index on the gold miners, it was literally at 100%. It couldn't go any higher. So, and that coincided with the record long interest by the speculators and the commitment of traders, and it correlated with a record short interest by the commercials. And if you model that out over the last 5 years, every time the commercials have gotten that net short, it has been extremely bad for gold. Now, it doesn't mean that it always holds, and it doesn't mean it'll always hold in the future. And I wouldn't put 100%, I wouldn't base 100% of my trading in gold off of just that one report. But I do think it is something that you can look at to help, you understand whether this is a good time to press a bet, whether this is time to reduce exposure a little bit. So I find value in it, but again, in a vacuum, I don't think you just use that report only.
Okay, so real quick, let's talk about 2017. What could we expect in the stock market? So Trump will be office hopefully he'll be office in the first month of January, unless something happens between now and December 19th. Who knows? But assuming he get into office, do you think his economic policies will do any good for the economy in the long term or short term?
I think his economic policies are better than President Obama's economic policies. I think anytime you're reducing taxes, that is a good thing. Let the people make the decision with their own money better than somebody in Washington decide what to do with their money. So from that perspective, it's good. I also think that, his idea to offer a one-time tax reprieve to bring corporate profits back, back into the U.S. to invest in the U.S. I think that's a good idea, right? The problem is he's also protectionist, right? And he is going to do away with some some of these trade deals, and he's going to do bilateral trade deals, which, again, I don't have a problem with that per se. But I have no doubts also that if negotiations don't go the way that he wants to do it, he's going to slap tariffs on people, or he's going to say, we're not going to, trade with you in a certain way, or we're not going to trade as much. And I think that leads to less trade happening. And I think that leads to less dollars flowing around the world. And I think less dollars flowing around the world plays into this strong dollar argument, because there's a high demand for dollars around the world. And so if there's less of them out there, it means the price of them probably goes up. And I think that I think we probably, in the best case scenario, maybe we get 1 to 2 quarters of kind of this positive energy in the market because of kind of a follow on to what we've seen the last 3 weeks. But I would be surprised if it lasted through the second quarter, and I wouldn't be surprised at all if it ended by the end of the first quarter. So I don't think we're going to get into this runaway growth scenario where, we're back to, late 90s type growth, or even the 80s type growth, where, rates are normalized, GDP's at 3 or 4%, and, we're this big economic powerhouse, and, all sins are forgiven. I just don't. I think we're past that point. I think the debts are too big. But I do think we're getting into a point where, because the debts are so big, I think we're going to get one last push down in rates. I think rates will come back down one more time. But I think after that, it's going to be time to get out of any fixed income, because then I think at that point, the debts are going to be so big that investors are going to start to repudiate the debt. And that's when I think interest rates will rise, because people will be spending money because they just want to get their hands on something, because they don't trust the bonds anymore. They don't trust the bond market. I think interest rates start to rise because they don't trust the collateral more than it starts to rise because of real good growth. And I think that's the point where we might get into negative inflation, where people start to get rid of their currency just because they don't trust it, not because they think this good inflation is showing up. I don't know if that answers your question or not, but that's kind of my long-term outlook.
Yeah, no, that's great. So I still think we're going to see a lot of volatility in the stock market, similar
Absolutely.
to what we saw in 2016.
No question.
Maybe we'll make all-time high again in 2017 again. I would not be surprised. Heck, we could see Dow in 20,000 next year. I would not surprise me at all.
We could see one big last blow-off. It would not surprise me to see one last big blow-off top where, the market extends further than anybody thinks it can. But I just think this all ends in tears. The math just does not work on it. When you look at it from a big picture standpoint, the math just doesn't work on any of it. The debts have to be paid one way or the other, and neither outcome is good.
Yep, and I also see gold and silver having another good year in 2017 as well. I think we hit a bottom here on the correction. I think 2017 we could see prices higher than what we saw in 2016. Well, things could change, but we'll see.
Yeah, I think by the end of the year, you're probably right.
All right, great. Well, Brent, thank you for your time. And if people want to find out more about your work, where can they go?
Sure. They can go to a couple different places. They can go to SantiagoCapital.com. Basically, that's just a landing page that has my contact information on it. They can email me, Brent@SantiagoCapital.com. So it's BRENT@SantiagoCapital.com. I also am part of a company called Baker Avenue Asset Management. So if you went to www.bakerav.com, I can be found there as well. But happy to talk to anybody and answer any questions that they may have. So I really appreciate you having me on.
All right. Thank you, Brent. I'm happy. Have a happy holiday and a happy New Year.
You too. Best of luck and have a great end of the year.